for the people who are willing to get into equities and realize the fact that equities will do double of inflation, and which is what will see you through many, many years in future, which will of course create wealth also over a period of time, that's the option. And for the ones who are still going to be a little conservative, or for the senior citizens where we know that fixed deposits will do 5-6% and they're struggling with that, maybe look at options like peer-to-peer lending, where you're more or less bypassing the bank, you're doing a similar activity, but your returns are then higher in the range of 8 to 11 to 12%. So that's the other thing that you can do. Debt funds also do about 5-6%. So therefore, I think there are two major options as I see in today's time. Equities is number one, perpetually it will create wealth for you. And the other ones, part of the portfolio could be put into P2P lending. Let's take inflation at 6%. And let us aim that we must earn about 12, because practically speaking, inflation is not really 6. That's the government number. In our lives, it's much higher, about 8 to 10%. So we aim to earn 12% growth on our money. Now, if you had to get 12% growth, what would you do? You would have to, let's say, put 60 to 70% money into equity, where we assume that our earnings are 15%. And the remaining 30 to 40%, let's say, in debt, where the earnings are expected to be 6%. So if you, for example, multiply 70% into 15% and then 30% into 6%, you get a mathematical average of about 12% plus or minus. So that means in today's time, even if you're a senior citizen, and I want to say that again, even if you're a senior citizen, you're not going to consume all the money on one day. But not having equity in your portfolio is going to be extremely, extremely dangerous, because in the future years, you might be 60, 65 now, but when you reach 70 and 75, and let's assume the interest rates are down to 4% or maybe 4.5%, what would you do? That's the time these equities could be translated and converted into fixed deposits. So therefore, at any point of time, 60, 70% is like a bare minimum. And if you're younger, even if you are at 90% or 100%, it's perfectly okay, because you've got so many more years in front of you. And don't worry, 20, 30% volatility happens all the time. But the only short way to beat a 6%, 8%, 10% inflation in our lives, and in a country like India, where social support system is not adequate, government benefits are not the way they are in the European countries and the Western worlds, where you have to do a lot for yourself. One thing, of course, buy your health insurance. The other thing, get all your money into equities,